Preparing for a E.ON FP&A Analyst interview questions and answers interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A contribute to a company like E.ON? FP&A turns financial information into decisions. At E.ON, I would connect operational drivers such as customer numbers, network volumes, energy prices, headcount, and capital expenditure to budgets and forecasts. I would explain variances clearly, challenge assumptions constructively, and highlight risks and opportunities for management. The role is not simply reporting historical results. It is helping the business allocate capital, improve performance, and deliver reliable energy infrastructure while maintaining strong financial control. While answering, focus on planning, forecasting, performance analysis, decision support, cross-functional partnering, and how FP&A helps E.ON manage regulated networks, customer solutions, investment priorities, and energy market uncertainty. Question 2. Why do you want to work in FP&A at E.ON? I am attracted to E.ON because it combines financial complexity with visible real-world impact. The company operates across energy networks, customer solutions, and the transition toward cleaner infrastructure, so FP&A can influence both performance and investment decisions. I would enjoy translating operational information into useful financial insight, working with non-finance stakeholders, and developing strong forecasting skills. This role also fits my motivation to build a long-term career in a business supporting Europe's energy transition. Make sure to cover E.ON's energy transition role, the combination of regulated and customer-facing businesses, analytical development, stakeholder exposure, and your motivation to connect finance with operational and sustainability outcomes. Question 3. Walk me through how you would build an annual budget. I would begin with strategic objectives and prior year actuals, then establish a clear timetable and ownership matrix. Each business unit would submit driver-based assumptions for revenue, operating costs, headcount, working capital, and capital expenditure. I would challenge unusual movements, reconcile submissions to corporate targets, and consolidate the plan. Before final approval, I would run downside and upside scenarios, document assumptions, resolve intercompany issues, and present the key implications rather than only the numbers. In your answer, talk about strategic objectives, bottom-up operational drivers, top-down targets, assumptions, stakeholder ownership, consolidation, review cycles, scenario analysis, and final approval with a documented audit trail. Question 4. How would you forecast revenue for an E.ON energy business? I would use a driver-based model rather than simply applying last year's growth rate. For a customer business, key drivers could include customer numbers, acquisition, churn, average consumption, tariff changes, contract mix, and energy procurement costs. I would incorporate seasonality, weather, regulatory changes, and current market assumptions, then reconcile the forecast to actual trends. I would also separate volume, price, and mix effects so management can understand what is genuinely driving revenue. Be sure to mention customer volumes, consumption, tariffs, energy prices, contract mix, churn, weather, regulatory changes, seasonality, and separating controllable commercial drivers from external market assumptions. Question 5. What is the difference between a budget, forecast, and long-range plan? A budget is the approved financial commitment for a defined period, usually the next fiscal year. A forecast is an updated view of expected performance based on current information and may change several times during the year. A long-range plan looks further ahead, often 3 to 5 years, and links strategic choices to financial capacity. At E.ON, I would use all three together: the budget for accountability, forecasts for decisions, and the long-range plan for investment direction. While answering, focus on purpose, time horizon, update frequency, ownership, level of detail, strategic versus operational use, and how the three tools should remain aligned without becoming interchangeable. Question 6. How would you analyze an unfavorable operating expense variance? I would first confirm the variance is real by checking actual postings, accruals, cost center mapping, and the comparison period. Then I would break it into price, volume, mix, timing, foreign exchange, and one-off effects. I would speak with the budget owner to understand the operational cause and determine whether it is recoverable or structural. Finally, I would update the forecast where necessary, quantify corrective actions, and communicate the impact clearly with an owner and expected resolution date. Make sure to cover validation against source data, timing versus permanent variance, price-volume mix analysis, accruals, business owner discussions, corrective actions, forecast implications, and concise management communication. Question 7. Explain how you would create a monthly management reporting pack. I would design the pack around decisions, not data volume. It would include a concise executive summary, income statement performance, cash and capital expenditure, operational KPIs, forecast changes, and a risks and opportunities view. I would validate source data and ensure definitions remain consistent across periods and business units. Commentary would explain causes, not repeat figures, and each material issue would have an owner in action. I would tailor detail for executives while retaining supporting schedules for review. In your answer, talk about data integrity, actual versus budget analysis, key performance indicators, business commentary, forecast changes, risks, actions, executive readability, and consistent reporting definitions. Question 8. Which KPIs would you monitor in E.ON's networks business? For a networks business, I would monitor capital expenditure against plan, regulated asset base growth, allowed returns, connection volumes, operating cost efficiency, outage frequency and duration, and service quality measures. I would also track regulatory incentives or penalties where relevant. The important point is linking operational KPIs to finance. For example, investment timing can affect asset growth and depreciation, while service performance may influence regulatory outcomes. I would distinguish leading indicators from lagging financial results. Be sure to mention regulated asset investment, allowed returns, connection volumes, network availability, reliability, operating efficiency, customer service, regulatory performance, and linking operational measures to financial outcomes. Question 9. How would you forecast capital expenditure for an energy infrastructure business? I would build the forecast from an asset and project register, separating approved projects, committed spend, and early-stage opportunities. For each project, I would model expected timing, procurement milestones, construction progress, inflation, and probability of delivery. I would reconcile the result to purchase orders, contract commitments, and cash flow assumptions. I would also assess capitalization, depreciation start dates, and delays, because a project's timing affects earnings, cash, regulated asset growth, and funding requirements. Focus on project pipelines, approved business cases, construction timing, procurement commitments, project phasing, inflation, permitting, execution risk, capitalization policies, and reconciling investment plans to cash flow and balance sheet effects. Question 10. How do energy prices and weather affect FP&A at E.ON? Energy prices and weather can affect both demand and costs. Colder weather may increase consumption, while temperatures, wind, and sunshine can influence renewable generation and balancing requirements. I would model these variables through scenarios, using market curves and historical relationships where appropriate. I would also consider hedging and contracted positions before attributing results to market movements. In reporting, I would separate underlying operational performance from external price or weather effects so management can respond appropriately. While answering, cover demand sensitivity, procurement exposure, hedging, temperature-driven consumption, renewable generation, scenario analysis, volatility, regulatory effects, and distinguishing operational performance from market movements. Question 11. How would you perform a price-volume mix analysis? I would start with the prior period revenue and bridge it to the current period using agreed definitions. Volume measures the effect of selling more or less at the prior rate. Price captures rate changes on the current volume. Mix isolates changes between customer, product, or contract categories. I would reconcile the bridge exactly to reported revenue and investigate any residual. For E.ON, I would be careful to distinguish tariff changes, consumption, customer churn, and energy market pass-through. Make sure to cover the bridge from prior to current period, consistent formulas, volume and rate assumptions, customer or product mix, residual effects, reconciliation to reported revenue, and communicating business meaning. Question 12. What is a rolling forecast, and when would you use one? A rolling forecast continuously maintains a forward-looking horizon, such as the next 12 or 18 months, by adding a new period as the current one closes. It is useful when prices, demand, regulation, or project timing change too quickly for an annual budget to remain reliable. I would update the key drivers, not rebuild every line unnecessarily, and preserve a clear variance history. This gives management a current outlook while retaining accountability against the approved budget. In your answer, talk about continuously extending the forecast horizon, replacing outdated periods, driver updates, reduced annual budget dependence, workload discipline, and suitability for volatile markets or changing investment programs. Question 13. How would you build a downside scenario for E.ON? I would begin with the risks most relevant to the business, such as weaker demand, adverse weather, higher operating costs, project delays, regulatory changes, or unfavorable prices. I would define explicit assumptions, quantify their impact on earnings, cash flow, capital expenditure, and liquidity, and avoid double-counting correlated risks. I would then model management actions, such as reducing discretionary spend or rescheduling investment. The final output should show sensitivities, timing, and decision triggers rather than one unexplained pessimistic number. Be sure to mention identifying material risks, defining independent assumptions, quantifying revenue and cost effects, timing, liquidity and covenant considerations, management actions, probability, and presenting sensitivities transparently. Question 14. How do you ensure accuracy when working with large financial datasets? I use a layered control approach. First, I confirm the source, period, currency, entity, and extraction logic. Then I reconcile totals to the general ledger or approved control reports, test key formulas, and review unusual movements against prior periods and operational drivers. I prefer standardized templates, controlled inputs, version naming, and automated checks for missing or duplicated records. Before distribution, I perform an independent reasonableness review and retain evidence so another analyst can reproduce the result. Focus on source system checks, reconciliations, control totals, automated validation, version control, exception reporting, segregation of duties, review evidence, and investigating unusual movements before distributing results. Question 15. Describe your approach to building an Excel forecasting model. I would separate the model into assumptions, source data, calculations, outputs, and checks. I would use driver-based formulas, consistent monthly dates, clear sign conventions, and minimal hardcoding. Scenario inputs should be centralized so users can change assumptions without rewriting formulas. I would include balance checks, reconciliation checks, and exception flags, then test the model using known historical periods and independent calculations. Finally, I would document definitions and assumptions so the model remains usable after handover. Mention clear architecture, input and output separation, driver-based formulas, consistent time periods, checks, scenario controls, auditability, limited hardcoding, documentation, and testing with independent calculations. Question 16. How would you use SAP or another ERP system in FP&A? I would use the ERP as the controlled source for actual financial data, including general ledger postings, cost centers, profit centers, entities, and project information. I would validate extraction parameters and reconcile outputs to control totals before loading them into reporting or planning tools. I would also investigate master data issues because incorrect mappings can distort business unit results. ERP data provides the accounting foundation, but FP&A still needs operational drivers and stakeholder context to explain performance. In your answer, cover extracting actuals, cost centers, profit centers, general ledger mapping, master data quality, reconciliations, planning tools, access controls, and combining system outputs with operational analysis. Question 17. How would you explain a financial result to a non-finance stakeholder? I would start with the headline and business implication, then explain the result using familiar operational drivers. For example, rather than saying operating costs were unfavorable by €5 million, I might explain that contractor rates and delayed hiring increased costs, partly offset by lower travel. I would use a simple bridge, avoid accounting jargon, and confirm the stakeholder's perspective. I would finish with the forecast impact, proposed action, and any decision needed from them. Make sure to cover removing jargon, starting with the headline, connecting numbers to operational drivers, using visual bridges, checking understanding, inviting challenge, and ending with implications or agreed actions. Question 18. Tell me about a time you challenged a budget assumption. In a prior planning exercise, a team assumed headcount costs would remain flat despite an approved hiring plan. I compared the forecast with recruitment dates, salary ranges, benefits, and historical hiring delays, then presented a monthly bridge rather than simply rejecting the assumption. We revised the phasing and added a vacancy risk scenario. The final forecast was more credible and improved cash visibility. That experience taught me to challenge constructively, using evidence and offering practical alternatives. Be sure to structure the example with context, the assumption tested, evidence used, respectful stakeholder engagement, revised outcome, measurable impact, and what you learned about balancing challenge with collaboration. Question 19. How would you prioritize competing requests during a forecasting cycle? I would rank requests by decision impact, materiality, deadline, control significance, and dependencies. A submission needed for an executive forecast or regulatory commitment would take priority over a low-value ad hoc analysis. I would clarify the required output and agree realistic delivery times with stakeholders. Where possible, I would use standardized templates and automate recurring work. If priorities genuinely conflict, I would escalate early with options, protecting quality instead of silently rushing critical calculations. Focus on materiality, deadlines, decision impact, dependencies, regulatory or control requirements, stakeholder communication, standardization, escalation, and maintaining accuracy rather than treating every request as equally urgent. Question 20. How do you distinguish a timing variance from a permanent variance? A timing variance reflects when an item is recorded, while a permanent variance reflects a change in the expected full-year outcome. I would review invoices, purchase orders, accrual reversals, project schedules, and prior period patterns, then discuss the underlying plan with the owner. If a cost is merely delayed, I would rephase it. If rates, scope, or volumes changed permanently, I would update the forecast. This distinction prevents both overreacting to monthly noise and missing structural deterioration. While answering, explain comparing commitments and activity timing, reviewing accruals and prior periods, discussing operational plans, assessing reversals, updating the forecast appropriately, and avoiding premature conclusions from 1 month's result. Question 21. What is working capital, and how would FP&A manage it? Working capital is the operating investment tied up in items such as receivables, payables, inventory, and accruals. In an energy business, billing cycles, customer collections, procurement timing, and settlement mechanics can materially affect cash. I would forecast balances using operational drivers, monitor overdue receivables and payment patterns, and partner with commercial and procurement teams on actions. The objective is not simply minimizing balances, it is improving cash conversion without damaging customer service, reliability, or supplier relationships. Mention receivables, payables, inventory where relevant, accrued costs, cash conversion, billing and collection drivers, supplier terms, forecasting, operational ownership, and balancing liquidity with service and supplier relationships. Question 22. How would you evaluate whether a cost-saving initiative is delivering benefits? I would establish a documented baseline and define the benefit precisely before implementation. Measures might include lower supplier rates, reduced consumption, process efficiency, or avoided headcount, with an accountable owner and delivery date. I would separate gross savings from implementation costs and normalize for volume, inflation, or business growth. Then I would track realized benefits in actuals and forecasts, investigate gaps, and ensure the same saving is not claimed by multiple initiatives. In your answer, cover establishing a baseline, defining measurable benefits, ownership, implementation timing, volume and price normalization, one-off costs, avoiding double counting, and tracking realized benefits through forecasts and actuals. Question 23. What accounting concepts are most important for an FP&A analyst? The essentials are accrual accounting, revenue recognition, capitalization, depreciation, provisions, leases, foreign exchange, and consolidation. I need to understand when economic activity is recognized, not only when cash moves. For example, a delayed invoice may require an accrual, while a qualifying infrastructure project may be capitalized and depreciated later. Strong accounting knowledge helps me explain variances correctly, avoid confusing timing with performance, and produce forecasts that reconcile to reported financial statements. Be sure to mention accruals, prepayments, depreciation, capitalization, provisions, revenue recognition, leases, foreign exchange, consolidation, and why accounting knowledge is essential for interpreting operational performance accurately. Question 24. How would you assess an investment proposal for a new energy project? I would assess strategic fit first, then build a cash flow model covering investment timing, operating costs, revenues or savings, taxes, working capital, and residual value. I would calculate NPV, IRR, and payback, but avoid relying on one metric. Sensitivities should test construction delays, cost inflation, energy prices, utilization, regulation, and financing assumptions. I would also consider accounting and balance sheet effects, then define post-investment KPIs to compare actual benefits with the approved business case. Focus on strategic fit, investment cost, operating assumptions, revenue or savings, project timing, NPV, IRR, payback, sensitivity analysis, risks, funding, accounting effects, and post-investment performance monitoring. Question 25. What would you do if senior management questioned your forecast? I would treat the challenge as an opportunity to improve the forecast, not as a personal criticism. I would walk management through the main drivers, evidence, assumptions, and sensitivities, distinguishing confirmed information from judgmental estimates. If an error existed, I would acknowledge and correct it quickly. If the difference reflected a legitimate alternative view, I would model it transparently and explain the consequences. The goal is a credible range, clear risks, and a decision-ready recommendation. Make sure to cover listening carefully, separating facts from assumptions, walking through key drivers, acknowledging uncertainty, validating with business owners, presenting sensitivities, correcting errors promptly, and maintaining confidence without becoming defensive. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.